This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. I don't say it on this podcast explicitly, but I release 2 episodes per week. One is always a new interview, brand new. Second, I will release a brand new monologue, just me talking. Or I might do a best of. Reach back to my archives and give you some great episodes from the past. I mean, when you've done a podcast for almost 12 years, is it longer than 12 years? I'm not sure anymore. You got a lot of content. And also, I will often give you a chapter or 2 from one of my many books, the audiobook chapters. Now, the last 2 weeks, I've given pretty intense monologues. Some people like to refer to them as rants. But today, something a little different. Today, reaching back to my archives, I want to go into trading psychology for a moment. 2 guests, Brett Steenbarger, Daniel Crosby, affectionately known as trading psychologists. They might call themselves something different. I'm not sure what the exact jargon is today. Perhaps that's exactly how they describe themselves. Both of these men have appeared on my podcast on multiple occasions. But today, reaching back many years ago, because look, I keep things fresh here. It's about timeless. I'm not wasting my time here to give you something that will have no value a year from now. People write me all the time and they say, I just started listening to your podcast. I started it on episode 1. And I'll say, hey, is it fresh still? And they'll say, yeah, of course. That's by design. So reaching back today to give you a little trading psychology, because damn it, if you're going to be a trend following trader, you need the thinking of these 2 men, the psychological thinking. Without any further delay from me, please enjoy a redux of Brett Steenbarger and Daniel Crosby. My guest today is Brett Steenbarger. He is a repeat guest. This is his 2nd visit. Brett is a clinical associate professor of psychiatry at the State University of New York. He's the author of The Daily Trading Coach, The Psychology of Trading and Enhancing Trader Performance. His newest work is Trading Psychology 2.0, From Best Practices to Best Processes. I always enjoy a conversation with Brett, because I truly feel like the kid in the classroom, that everything Brett is going to say or talk about or write about, I have to pause, sit back, think, contemplate. Brett's not just giving the sound bites. There is a tremendous amount of depth behind his thinking and his insights. I hope you enjoy this conversation with Brett Steenbarger. I've seen you make the comment, you're paraphrasing, you're quoting from Bobby Knight, and I'm guessing you must be a fan to some degree. Why do so many of us have the burning desire to succeed, but not the drive to prepare for the success? Before you answer that, I want to add one thing to that. Do people really have that burning desire to succeed?
It's a great question. I do believe the majority of traders go into trading with ideas of success. Now, those ideas may be fantasies, they may be plans, but they're drawn to trading in large part, for the outcomes. The problem that often occurs, and I see this more among beginning traders than experienced ones, is that part of what draws them to trading is the allure of not working a standard 9-to-5 job, and that it seems to them that this could provide relatively easy riches. And of course, as you and I know, it's much more than a 9-to-5 job when you do it right. The fantasy of the easy riches collides with the reality of what you need to do to prepare to win. And I think that creates quite a dissonance for many beginning traders and ultimately leads them to leave the field.
So is it a burning desire more for it's a burning desire for the outcome, but not too many people will take the step back and say, okay, hold on. And maybe you get into it, you say, I just see the outcome. And then you get into it and you take a step back and you start to break these pieces apart and you say, hold on, we can't just focus on the outcome or we will go crazy. We must break this down. We must look more at our process. Why don't you talk about that? Because I've seen you in some of your recent work, and I would love for you to draw some distinctions here from process to practice to process. Break that apart in how you're describing to clients and people that read and follow your work.
If I can address the earlier point, which I think is a good one, the distinction I like to make is between those who have a self-proclaimed passion for trading and those who have an enduring passion for markets. Those two are very different, and the person with the passion for trading wants to trade and ultimately ends up over trading. But when markets are closed, there's nothing to generate passion. That's very different than the person who has a passion for markets, where it's more of that process interest of understanding, unraveling, reverse engineering what's going on in markets and figuring out ways to better exploit that. So I think those are very different motivations and end up with very different consequences for traders. Your second question about practice and process, to me, is essential. And that's really what one of the big factors that got me to write this latest book of mine, The Trading Psychology 2.0. So often you hear traders talk, and again, I see it more with the beginning traders. You see traders talk about finding your edge, sticking to your edge. All well and good. However, that, of course, doesn't take into account the reality that markets are ever changing and that finding your edge is a continual process, that as markets change, edges, sources of edge, evolve. And so we always have to be evolving ourselves. The way that happens in the medical world, where I came from, is through identification of best practices. What are the practices that lead to the best outcomes? And then turning those best practices into robust processes so that the best practices become habit patterns. They become automatic. I think that analogy in evidence-based medicine is quite apt for trading. We want to find the drivers of our success, what makes us successful, and turn those into processes that become replicable.
I'm going to break apart some of the big picture issues in your current life, your current world, your current work. But as you mentioned, markets always changing. And one of the lessons that you talk about in being around so many traders, studying, teaching, training, is adaptability. And literally from the beginning, if one strategy is not predicated on being adaptable to the markets, and the markets are the driver, we can't control the markets. And so whatever the markets must do, and they will do something, adaptability is number one, isn't it?
Absolutely. A great recent example that I've written about is in your area of expertise, Mike, and that's trend following. Trend following, as it occurred in the late 1990s, is quite different from trend following right now. There are portfolio managers and traders I work with who are trading trends, who are trying to identify trends to trade, but the way they are executing on their trend trading is more similar to what happened in the late 1990s, where they are confusing, I would say, trend with momentum. So that if they're long, they're buying strength. If they're short, they're selling weakness. What we've seen recently are markets that show anti-momentum in the short run, even as they are trending. A different way of saying that is that the trends have a lower Sharpe ratio. How you implement a trend-following approach requires adaptability. You may stick to your basic orientation to markets, i.e., trend following, but how you make that happen, how you put it into practice, has to be based on outcomes and your study of markets. That's where the adaptability comes in.
You know, it's an interesting point that you bring up, and it gets even more complicated as the numbers of large funds that we all read about, that we see the headlines, we see the quotes from, trying to decipher, you know, when you read about a large fund that's managing billions and billions of dollars, and let's say that they started off as a trend following fund, and perhaps they still have billions and billions of dollars still as a pure trend following trader. But there are many funds today where they're adding other things and they're adding other strategies. That raises up a whole different issue, which is really one, in my humble opinion, not really of markets, and it's more a result of clients. Because when I talk to the pro trend following traders, if you talk to them on the record for public consumption, they're going to talk about a certain way, and it really is an appeal to clients. You get them off the record when the microphones turn off, they're just like, oh my gosh, it's such a pain in the neck to deal with clients that don't understand our strategy.
Yeah, that makes a lot of sense. And I think for a fund, diversification makes sense, and having multiple approaches. And so there may be trend following approaches, and there may be relative value approaches, and so forth and so on. You know, I think having diversified sources of return is a good thing for investors. One of the things that I've seen in the fund world is that investors have very limited appetite for the downside. And I would say that's been true ever since the 08 debacle, that they want to see funds make money. They don't want to see funds lose money. And so funds are managing risk much more tightly than in the past. So that even though in name they may be trend followers, in fact, any wiggles against the trend, that lower Sharpe ratio that I mentioned, ends up getting them out often at the worst possible times. So that sometimes it's the business pressures and the pressures of risk management that make it difficult for a trader to implement their strategy.
I would also advise clients or people that are interested in a subject like trend following. We're going to talk about a lot of different aspects of trading psychology today, but sometimes the performance proof, you know, you can go to those track records. Those track records often have remarkably insightful data about them. And you can look at those track records, and I can think of some names, and you look at those track records and you say, wow, they've stuck to their religion, so to speak, for decades. Then you can look at some others and you say, you know what? A very consistent return number every month is just not trend following, even though it might be advertised that way. So I think it's really incumbent on individuals to do their homework and really try and find out, because sometimes the public pronouncements don't match the performance data.
It's a great point. And one of the downsides of having so much computing power and software power right now is that it's relatively easy to backtest strategies. With enough iterations, you can find randomly a strategy that will look good not only on the backtest, but on out-of-sample performance. So it looks like a very smooth, wonderful, ideal P&L curve, but of course that doesn't match the reality of real-time returns.
You do bring up a good point, though, about the backtesting. I mean, backtesting and trying to, if you're in the systems world of some type of system, I mean, a backtest, that's where it all starts. And I'd like for you to lead this into a broader subject area, which is preparation, because so much of elite performance really starts at that research level, that preparation level, that backtest level. And the ultimate execution often can be very quick or can occur in a fast manner, but it's all that prep time, that real deliberate practice is where the gold is made, so to speak.
I think so. And as I mentioned in the Trading Psychology 2.0 book, the key in performance fields is that elite performers, spend more time in preparation than in actual competitive performance. That there's a lot of practice time that goes into the curtains being raised on the Broadway play. There's a lot of practice time that goes into the first game of a chess tournament. And that preparation works at two different levels. It helps develop a strategy, an approach, and it helps prepare the performer mentally, psychologically, emotionally. That preparation time, I found, is correlated with success to the degree that it pushes the trader to expand their horizons and develop the best of what they're doing.
Let's just talk about pro traders for a moment. You've seen pro traders at the highest levels. Why don't you draw some contrasts? For example, I think the audience might have a hard time imagining that there are some pro traders at the highest levels, perhaps, maybe with long track records, perhaps a lot of money under management, and the way they go about practice might not be nearly as good as one of their peers who might have deliberate practice down to a science. Everything is really thought out. There's some contrast, even at the highest levels, isn't there?
Very much so. I'm really blessed by being able to work with a number of very talented traders and very successful firms. In fact, the smallest firm that I work with has about $3 billion under management. So, traders in those kind of firms have to do something right and have to have some real strengths to get to that point of managing significant capital. But you're right, even within those funds, between PMs, there are real differences in the preparation approach. And I would say there are two sources of difference. One is the one that you mentioned, the difference between repeated experience and deliberate practice. Some managers of money, some traders really rigorously keep score, and they try to learn from their trading. And what did I do wrong? What could I improve? How am I going to improve it tomorrow, next week? So they're constantly keeping score, setting goals, and then keeping score about whether they reach those goals or not. That's the essence of deliberate practice. The second thing that distinguishes the successful traders is the emphasis on what they do right, their strengths. What positive psychology research is telling us is that it's leveraging our strengths, not just shoring up weaknesses, that accounts for elite performance. And so we want to figure out, what are we doing well? Because those are the practices that will anchor our best processes. And so in two different respects in preparation, identifying what we're doing wrong, correcting that rigorously, identifying what we're doing right, and turning those into best practices, that is real preparation.
I only brought it up because it was in your work most recently, but deliberate practice, I'm my fingers crossed. Anders Ericsson has said he will come on in 2016 to talk about his seminal work. So I look forward to that. Let me drive back at the strengths aspect for a moment. So let's say we're kind of giving advice to the new trader at the table to some degree. And let's say we're kind of talking more of a system mindset. And I think these days, most everything is a system to some degree. I mean, even if it's a discretionary type thinking, there's a system behind it. But talk about strengths, because it seems like to me, one doesn't really have the ability to think too much about the strength they have. Let's say you're going to be a systems trader. As a systems trader, you have to have your entry exit criteria. You have to know how you're going to manage your portfolio. What's the risk management strategy? You can't just leave one out. So I would love for you to kind of elaborate more on the strengths part, because it seems like you're saying, and I could be reading this wrong, that we all have there's some built-in strength about one aspect, and to kind of really focus on, correct me, what am I missing here?
Well, no, I don't think you're missing anything. I do believe that the strengths that make a good systems trader are different from the strengths that make a good discretionary trader. So much of the success of systems pertains to the research and the quality of the research that's conducted. And so, in some ways, the strengths that are relevant to a system trader are not so different from the strengths that are relevant to a medical researcher. The information you take in, how you process that information, how many variables you look at one time, and how you weight those are all part of what can be best practices. There are also strengths interpersonally. Many times the research is too complex to be conducted individually. I work with some people who develop relatively high-frequency systems. And those systems are developed in teams. There are programmers, there are quants, there are traders. And so being able to work well with others, those are strengths that are very relevant to best practices and to ultimate outcomes in the systems world. For discretionary traders, strengths are different and often pertain to the amount and type of information that's taken in, how that information is translated into tradable ideas, how those ideas are expressed as positions and managed as positions, including the risk management. And of course, there are best practices related to not only risk management and position management, but self-management, how we take care of ourselves. All of those go into making someone successful. There's no one process of trading. Trading consists of multiple intersecting processes.
I brought something up a few minutes ago. I talked about some of the big things that you've learned from all the traders that you've looked at. I mentioned adaptability, creativity, productivity, and self-management. Why don't you talk about creativity for a moment? I have a feeling for many traders, just even entrepreneurs, venture capitalists, creativity for those that are in the business, they probably think of it as instinctive. It's something I do all the time. But defining creativity like you've done changes the ballgame a little. It forces us to think about the word creativity. And I don't necessarily know that a lot of people would immediately think, oh, I have to be creative to be a trader.
Yes, to the degree that we regard trading as a business, then I think it makes sense to say we have to be doing something unique in order to be superlatively successful at this business. If I open a hamburger stand that's just like every other hamburger purveyor, then how am I going to achieve a significant degree of economic success? I have to do something different, unique. And it's in that difference, that uniqueness, that creativity comes into play. We see that in financial markets because many times the herd is following a similar set of strategies, looking at the same information and processing it the same way. And that's why you see swings in sentiment that often end up being relatively good contrary measures. That's why you see many people getting hurt at the relative tops and bottoms of markets, because they are doing things that really are not unique, not creative. It's particularly an issue in the professional money management world, where there tends to be a high correlation among financial markets. The Financial Times had a piece on that recently. There also, as a result, tends to be a high correlation of returns among portfolio managers within a firm and across firms. And so that is a problem for investors. Investors want to diversify their capital. A trader who has the creativity to examine, test, and implement new strategies is going to be very appealing to anyone who invests and wants that diversification.
You know, you just mentioned, you said, well, clients want the diversification. And we talked earlier about, you know, sometimes clients actually, they might say they want diversification, but then they're doing anything they can to avoid volatility, to avoid taking excess risk. And I was thinking, as you were just talking about, okay, so many investors, traders, they're looking at the same info. They're processing that information in the same way. There's nothing unique about it. And they're simply fixated on comfort. And as you point out in your work, it's the adaptation. It's got to hurt a little, the hurting a little, or maybe even hurting a lot. That's where the reward often is. In some kind of perverse sort of way, that desire for comfort can set one up for, as Nassim Taleb talks about so much, the black swan. So comfort's often illusion, isn't it?
I agree with you, and it's hard to imagine us extending our boundaries, really transcending who we are, if we aren't willing to go outside our comfort zone. That can be done in a variety of ways. It can be done by looking at new markets. It can be looking at existing markets in new ways. It could be looking at new and different time frames for implementing our trading. There are many ways of doing things new and different. One example from my own recent trading, it has been a redefinition of volatility. I find that volatility is very important to market returns, and in the models that I create, volatility ends up being an important variable. As we know, with stocks in particular, volume and volatility are highly correlated, so that markets move more when there's more participation, which makes sense. But I got it in my head, well, what if I looked at volatility a different way? What if I looked at the volatility of a given amount of volume in the market? If X number of shares trade or X number of contracts trade in the market, how much movement is associated with that amount of volume? You're disaggregating the relationship between volume and volatility, which I call pure volatility. And it turns out that that has real value as a variable for understanding markets. Because when you see volume expanding, and when you see the movement per unit of volume expanding, you can get some very big moves. That's an example of creativity, looking at something similar in a unique way.
We've been talking about markets, how markets are the drivers. But at the end of the day, yes, markets are the drivers. We as individuals have certain built-in, and I want to kind of let you break this apart. We've got a certain personality. We've come to the game with something. We behave in a certain way. We think in a certain way. We react in a certain way. Our emotions go a certain direction. But I find the word personality is often difficult. And I know you point out, and correctly so, and Jack Schwager has said it for a long time. He said, you got to trade your personality. But I think for a lot of people listening, that might be really hard to digest. You say, well, hold on. I don't necessarily even know how to define my personality in any kind of a rigid or quantifiable way. One could go out. There's several personality tests out there. Or personality instruments, shall I say, since I am actually qualified to administer the Myers-Briggs instrument. It's not a test. So, but that can be confusing, and there can be debates about that. So why don't you break apart the word personality from your perspective and give some guidance to the audience out there that's thinking, man, I might not even be sure what my personality is. And if I do know, how do I make the decision to go which direction? It becomes a quite complicated conundrum to figure out, doesn't it?
Yes, I agree with you, and I think it's even more complex than your question implies, because as you mentioned earlier, it's not just personality traits, it's also our cognitive style, how we think about things. We have personality traits, emotional traits, we have cognitive traits, and so we want to leverage our strengths in both of those domains. Again, I think that reverse engineering the success of our trading can provide some real clues as to some of those strengths, some of those signature personality and cognitive strengths that would contribute to our success. What I found from the research I've done with traders is that average holding period ends up being a very important variable, particularly on the cognitive side. I would make a distinction psychologically between a trader and an investor. The longer time frame necessitates a higher degree of underlying research, and the longer term research becomes really the focus of the trading of the market participation, not the day-to-day movements of the underlying assets. That's a very different set of strengths from, let's say, the day trader, the active day trader, who is looking at markets moving rapidly, is seeing patterns set up very quickly in markets and trading those patterns. So there's very little explicit research, reading, calculation. It's all about fast pattern recognition. The distinction that has been made between thinking fast and thinking slow is very relevant there. The deeper thinking, the faster pattern recognition. And as Kahneman talks about, those are really two different brain functions and two different modes of processing information. Now, in addition to that, we could distinguish two types of trader or investor, personality-wise. One is highly risk-taking. They tend to be more outgoing, more extroverted. They tend to be more stimulation-seeking, more aggressive, and are willing to take more risks in the pursuit of higher returns. The second group of traders is less interested in absolute returns than in risk-adjusted returns. They're less risk-taking. They're seeking smoother P&L curves, higher Sharpe ratios, and very often are seeking what we would call alpha rather than beta. They tend to be more analytical in their cognitive style. They tend to be more introverted in their personality style, and so a very different approach to markets. Those two dimensions, the holding period, the research orientation versus pattern recognition orientation, and the element of risk seeking versus risk-adjusted return seeking are just a few ways people could think about personality and cognitive style and how that might relate to some of their strengths.
Brett, I know your job is not necessarily to offer a personal opinion about what I'm going to ask you, but I'm curious because you just mentioned the phrase smoother curves. And if I think back over the last 15 years, we've had two, if an investor, if they classify themselves as an investor, just to kind of a buy and hold approach, an index type approach, we've had two 50% drawdowns in the S&P. I think it's reasonable to assume that if that's one strategy to trust the S&P, it's reasonable to assume that could happen again. And now, of course, when it comes to trading strategies like trend following, a smoother curve, if somebody says they want to be a trend following trader and they want a smooth curve, I would say, well, then you've got the wrong strategy. There's no such thing. But is there really a smooth curve for anybody? Except, as you mentioned earlier, and you didn't say this, but the pro high frequency traders that can generate, I think I read a couple years ago, one of the big iBanks, is literally they made money every day of one quarter. So, but I don't even know if that's trading. That's technology, that's infrastructure, that's access. That's not a competitive thing where I can compete against JP Morgan on the high frequency level. I can't. But talk about that for a second, the idea of a smoother curve. Is that just a false ideal, a false goal?
Not at all. Not at all. I think for any one strategy, the P&L curves are likely to be bumpy. And as you point out with the S&P, for instance, if one were simply an index trader. However, the idea of smoothness of P&L curves is really all about diversification, portfolio construction, and combining different approaches to markets to balance the returns. The basic risk parity notion of buying a volatility-weighted basket of interest rate instruments and equity instruments would be a case in point that in recent years, that basket has had a smoother P&L curve than either asset individually. You could expand that more broadly to a basic asset management approach. For instance, if you think about returns as being generated by certain factors, trend or momentum could be one factor, value could be one factor, carry could be another factor. Then you can combine investments or trades that express those different factors and that harvest returns from those factors in a smoother way than if you were trading one strategy in isolation. And so asset management in general as a field, I think, is all about achieving smoother returns, more unique returns, rather than chasing beta from any given market.
Yeah, I was definitely just speaking to one strategy. I think of course you're right. Once you add in multiple strategies, the notion of trying to find a smooth curve is that's the goal. That's what many people do, I guess. But in the notion, I think if some people think they can find a smooth curve, a smooth equity curve from just one strategy in isolation, that might be very difficult.
I agree with you. You know, probably the Bible of the asset management world would be Antti Ilmanen's book, Expected Returns, and very much worth reading about, because I do think that there are things that individual traders can do to improve the smoothness of their returns. Even as you say, they can't completely smooth them. There's always going to be those bumps in the road. A very simple example would be trade expression, that a given view in a given market may have more favorable risk reward if traded with an option structure than if traded with an asset outright. There are ways, I think, of achieving better risk reward, but that doesn't eliminate the potholes along the way.
For all of these, and we're not necessarily defining strategy here at the moment, but regardless of what one strategy is, talk about the emotional buy-in. If there's no real emotional buy-in, success is just never going to happen, is it?
Well, it's a very good point. And the emotional buy-in occurs because the trading approach or the investment approach is genuinely yours. You have researched it. You have thought about it. It springs from your creativity. It springs from your work. And it's the time and effort generated that generates the strategy that helps you understand it and believe in it. That's why it is perilous to borrow trading strategies from others, because at the end of the day, you're really not trading your strategy, and it's unlikely you will have the conviction to stay in that strategy during those inevitable periods of drawdown.
Well, of course, you're talking to a guy that wrote a little book on the turtles, and I think some of them would say it's nice to have a head start. And I think it's kind of it's a multifaceted point, really, which is if you take a strategy, if somebody gives you a strategy and you don't understand it, and you're just going to follow it like a black box and just trust the signal that comes out, that's death. You're not going to make it. However, we all have to learn from somebody. We have to start somewhere. So if you can get a head start, if you can move down the path, as long as you understand what's going on, of course, that's how we all learn. So it's kind of a several layers there to that topic, huh?
Yeah, I love that point, and it's really about mentorship. And I see a lot of good mentoring at the firms where I work. You're right. In the very beginning, when you have a junior trader who is working at the side of a senior trader, it starts with a head start. It starts with the junior trader mimicking the trading of the more senior trader. And just like in the old days, the beginning painters mimicking the brushstrokes of the masters. That's what mentoring is all about in the earliest phases. And it is a head start, as you point out. It's over time, as people make their own unique observations of markets and adapt their trading to their strengths, they start to develop their own style and begin to express that approach to trading in their own manner. To take the example we've been talking about, someone may learn at the feet of the master trend following, and over time may implement it in new and different markets, may implement it on different time frames, may implement it on relative price movement rather than absolute. There would be many ways to make the strategy one's own over time and develop that conviction that helps people stay in the strategy once it's theirs.
Let's talk about the notion of a checklist and ultimately moving that towards a flow chart, something concrete. I mean, it's a standard operating procedure. I mean, really, and if people are listening to you, I asked you the question about personality. Your personality as you talk is your work. I mean, anybody with a pulse would read your book and then listen to this podcast and they'd be like, okay, those are both Brett. Those are both Brett. I mean, there's, you just know, we're dealing with the same person. As my mother had read my books and she said, okay, that's you. I can tell that's you. But talk about the notion of a checklist, because in your personality, that I have a feeling just is simpatico. It's natural for you. It might not be so natural for other people. Or am I wrong? Was it natural for you, the checklist?
No, I wouldn't say it was natural, and I think that for me it was part of an evolution. I think that's true for many people. When Atul Gawande wrote the book, The Checklist Manifesto, he wrote it, I think, because he saw that checklists were not standard operating procedure for most people, and yet they worked remarkably well for airline pilots, for surgeons, and so forth. And so the idea of a checklist is to figure out those best practices. What are you supposed to be doing when you perform well? And you codify that in a list. And you don't perform, you don't risk your capital unless you do A, B, C, D, and E. Over time, you may discover new and different best practices, and so your checklist will evolve. But it's a way of grounding yourself so that once again, those best practices turn into habit patterns. They turn into processes.
Brett, how many traders do you get that come across you for the first time? Maybe they've engaged you, maybe it's just casual conversation, and they've got so much excitement. And maybe that excitement is an unbridled excitement. It's not necessarily focused. They're focused on the outcome. Your personality probably does a very good job of calming people down. And if they can't calm down and take it to a checklist type scenario, it's probably a pretty good self-reflection of saying, hey, you know what? Maybe this isn't for me.
Yes. And again, a good point. Many people are trading implicitly for action, for thrills, for there's nothing worse for them than a quiet market. That approach to trading really rubs against the grain of being more process focused and keeping checklists. So that I like people to be passionate about what they do. I like them to be excited about their work and about what they discover and what they trade in markets. But ultimately, you want them doing what works best. A great example in baseball history, of course, that you know about is Ted Williams and how he diagrammed the strike zone and determined his batting average for every possible location of a pitch, so that he knew where a pitch would have to appear on the plate for him to have the best odds of getting a hit. That's what people do when they develop best practices and checklists. They figure out what they do best, and they turn that into a set of routines.
Brett, I have one more thing I wanted to bring up with you today. I forgot to bring it up earlier. It's not really intertwined in our conversation. It's more on the outside, but I think, frankly, once one understands it, it's on the inside. And that's the notion of fitness. And I'm talking about physical fitness. I think we can all think back to some article we read in our youth, or we saw a picture. Maybe there was a trader or a very successful person, and they just carried in their public pictures an appearance that was clearly not healthy. And sometimes I think maybe even as a young man, I would say, okay, well, I keep myself healthy, but you might be thinking, well, it's not important. And I think overall, though, that even if you can think to the example of somebody, that guy, he made hundreds of millions of dollars and he's really overweight and doesn't care about fitness, that's the wrong connection. That's the wrong way to look at it. Why don't you talk about health and fitness and perhaps even add in a little bit of your views on yoga and the moment of now?
Great questions. The research in psychology tells us that a positive emotional experience is associated with superior processing of information. It's associated with superior productivity. It's associated with superior creativity. Maximizing our positive experience in general is a way of preparing ourselves for trading performance. Part of that is our physical preparation, our energy level. Eating is part of that. Sleeping well is part of that. Physical exercise is part of that. Using yoga or meditation to help increase our focus and to help us stay calmly focused is part of that. The training that we do on the physical side, on the personal side, ends up fueling positive emotional experience, and that ends up giving us greater focus, concentration, energy level in our trading. I would say the same thing, not only of exercise, but of the quality of our personal relationships. That maximizing our positive experience from those ultimately fuels our energy level, and that ultimately fuels our trading.
Brad, it's cool stuff. We could talk forever. I could just sit here and pick up ideas and pick up questions, and we could just keep going. The book is out. Where can we send people? Where's the best place we can send people to check you out and your assorted books? All highly recommended. If you've not bought them, then you know there's something wrong with you.
Well, the nice thing is plenty of stuff online for people to check out, and they can decide if
you've given so much stuff for free away over the years. I mean, checking out your blog and stuff, that's a wealth of information. So.
Well, thank you. Yeah, that's really where it starts, is with the Trader Feed blog. That's Trader Feed, all one word, TraderFeed.blogspot.com. I post to that daily. And then I'm writing a blog also most recently for Forbes. You could check out by Googling Forbes, Brett Steenbarger. And then, of course, the most recent book that I alluded to earlier, Trading Psychology 2.0, is available at a discounted price on Amazon, and really puts together, I think for the first time, puts together positive psychology research, recent psychology research, and what that specifically means for trading performance. That's what got me excited about that book. That might be worth checking out.
Even though it's about trading, I mean, we could really take out the phrase trading, and your work could apply to just about any discipline.
I think that's very, very true. You know, trading happens to be the playing field that I've chosen and others have chosen. But in fact, the principles of performance are common across disciplines. Ultimately, we pursue the disciplines that speak to us.
Brett, hopefully you will come on again in the future and educate my audience, educate me. I think my blood pressure goes down just talking to you. I can't get as excited as I normally might be.
I wish it was that way for my kids.
Brett, thank you. Take care.
Okay, thanks so much, Mike. Great stuff.
My guest today is behavioral finance expert Daniel Crosby. Today we talk his book, his newest book, The Laws of Wealth, Psychology and the Secret to Investing Success. Wide ground covered today. There's nothing easy about tearing apart how psychotic most of us have become when it comes to investing, when it comes to our money. Daniel brings great perspective. I hope you enjoy this conversation. So Daniel, let me jump right in with the big picture as I go through your work. The efficient market theory. This is not something every investor knows about, but they should. And I have to say that recently, probably in the last 2 months, I watched a video, an interviewer interviewing Eugene and Dick Thaler right there in the same room. A really fascinating interview. As far as I could tell, they didn't agree about anything. They didn't agree about anything other than they respected each other for their academic achievement. So they didn't seem like they were mean or nasty to each other, but they just didn't agree on anything. I would tend to think that I'm going to fall over on the Dick Thaler side more so, but he's also a little bit different camp than other people. In fact, I have to be frank, he so far has not granted me an interview. And the funny thing he said to me at one point in time, he said, well, if you like Dan Ariely and you like Gerd Gigerenzer, you won't like me. So I was my first taste of the competitiveness in the behavioral side of things. Beyond that, let's start to break apart the efficient market theory. Why don't you, for the audience, put your best teaching cap on and explain it, and then we'll start to tear it apart and look at it from different angles.
In the simplest possible terms, the efficient market hypothesis says that the price is always right. So, the price that you see is the correct price, or at least the closest to the correct approximation of a price you'd ever get, and that you can't beat the market. Those are sort of the two legs to the efficient market hypothesis. And it's interesting. You mentioned Gerd Gigerenzer and Thaler. Those guys hate each other. So even, there's a lot of disagreement between the efficient and the behavioral camp, but even within camps, there's quite a bit of dissension.
And I'm less familiar with, and this is kind of a side note, I'm less familiar with all of Dick Thaler's stuff, but I've read Gerd Gigerenzer's Risk Savvy. He's been on this podcast several times. I don't see anything that causes me, from a logic standpoint, to go, "Oh my gosh, that's the end of civilization." What Gerd just said, it just seems very, in many ways, common sense, plausible. So I guess, like you said, some of these debates get off pretty intense, huh?
Yeah, absolutely. And I think sometimes where it goes bad is when they devolves from sort of critiquing ideas to critiquing individuals. And I think that's maybe where that one's gone.
Yeah. Well, there's no doubt. I think when you get, and I'm not talking about these folks, but look, I'm not an academic, but I had enough experience in academia to know that some of the personalities and egos are pretty big.
Yeah, no doubt.
Let's dig a little bit more at the efficient market part. The markets, you can't beat the market. So I've been at this for a little while, and I've kind of in this one strategy, this time series momentum, otherwise known as trend following. Gosh, it sure looks like to me there's a lot of evidence that you can beat the market. That is momentum on that side. Then you've got Warren Buffett, you've got Howard Marks, you've got all these people out there that have done quite well. Seth Klarman, there's a whole army of people that have, quote, beat the market. And then on top of that, I guess when I look at 2008, I don't know where the efficient market hypothesis or theory, how that explains what happened in 2008.
Yeah, well, I think that's why you're starting to see it break down. You're starting to see it break down in the face of these bubbles, panics, crashes. And, the thing, so to try and argue the other side, because I don't believe in the sort of the strongest form of the efficient market hypothesis, and I don't think many people do, frankly, anymore. But the strong form efficient market theorists would say, look, you've got however big the number is, tens of millions, hundreds of millions of people in the market. Probability says even if you have monkeys throwing darts at the Wall Street Journal, you're going to occasionally get a Warren Buffett, a Seth Klarman, or a Howard Marks, a Joel Greenblatt, whoever. And so they say, look, you're gonna get some winners in a system that big. There's nothing special about these folks. But I think where that breaks down is certain types of investing have consistently outperformed, specifically value and momentum strategies have consistently outperformed, which leads me to believe that maybe it's not monkeys throwing darts at stocks, but maybe it's something about these strategies. And in my book, I talk about, I think that the reason these strategies have persisted is because there's a strong psychological underpinning to both value and momentum approaches, which is hard to arbitrage away. It's hard to arbitrage away bad behavior.
Let's talk about rules for a moment. This is something that's big in your work. So for me, I know more about the trend following side, and most trend following strategies apply today. Again, for people that want to call it something else, they can call it time series momentum or whatnot. But most of these strategies are literally automatic. They're 100% systematic. It's all rules. shed some light for the audience out there that might be wondering, and also too, I think you'll find the population of trades in some of these momentum strategies. You have so many more trades, so for this to all be kind of luck is kind of crazy. But on the flip side, I think one could make an argument, and I would love for you to elaborate on this. On the value side, are things as systematic? And on the value side, you could have a situation where a value player has made a half dozen brilliant long-term bets in their career, and that alone can really make you a superstar in investing lore.
It's interesting you bring up something a gap that I think I'm trying to bridge in the book. Typically, you've thought of trend followers, momentum folks as quantitative, higher frequency traders, whereas the value folks have been, have traded less, have had more concentrated positions, perhaps, and have been more of a discretionary mindset. I talk about rules-based behavioral investing, and one of my pillars of that is something that I call consistency, or just following rules. And I do identify as sort of a combo value momentum investor, but I think that anyone who's a behaviorally informed investor is going to fall down on the side of rules. In the book, I cite a meta-analysis. So this is a study of all the studies on following simple rules versus leaning on your own discretion. And when we're talking about discretion in these studies, we're typically talking about expert discretion, PhD level discretion in everything from prison recidivism studies to stock picking to making a medical diagnosis. And what they found in these over 200 studies is that expert discretion is beaten or matched by following simple rules 94% of the time. And at a much greater, at a cost savings, of course, because you're not paying, 10 CFAs to go out and meet with managers and try and make these discretionary decisions. So there's the big cost savings, and then there's also the headache savings. I mean, you can kind of go live your life instead of, being up at 2 a.m. to look at Chinese soybean futures or whatever. So, this is something that I think that makes a lot of sense. The research says it makes a lot of sense. You can do it more cheaply, and you can also do it with a higher quality of life. So I hope this is where the industry's headed.
Not to be a homer for my world, but I guess in your work kind of opens up this discussion. When I think about the trend following type strategies, which are way, way, way away from high frequency stuff. I mean, it's much more longer term. I mean, you could have trades on for well over a year. To me, it seems like it's the perfect example for showing the problems with efficient market theory and the benefits of the behavioral side of things, because you have these 100% systematic type strategies that are showing this long-term performance. I mean, you've seen the studies as much as I have. The time series momentum studies are in. This works, but it's so just naturally fits, like dovetails with everything that a Daniel Kahneman and Amos Tversky did. It just dovetails completely. And again, I'm not bringing this up to try and push trend following. I'm just saying it's an interesting example, especially in the spirit of where you've gone in your book.
So I think it's interesting, and I think you're seeing a push towards a greater acceptance of trend following within what we'll loosely call the behavioral community. Because to be candid, there's all kinds of, there's two or three handfuls of people who I think identify as behavioral finance informed investors, and most of them I would classify as high conviction value shops. But I think increasingly you're seeing people come around towards trend following, towards acceptance of momentum, because we're beginning to recognize the sort of psychological underpinnings of these things. We're recognizing that some of the reason that momentum persists is because of people's tendency to overreact or underreact, or our tendency to update our preferences slowly, our tendency to project the now into the future sort of indefinitely. And so I think a lot of behavioral folks reacted negatively to charting and trend following and related concepts because it was sort of seen as voodoo. But I think that as we build behind some of build the psychology behind these concepts, I think they gain greater acceptance in my world, for whatever that's worth.
Yeah, it's an interesting, we could go off on a side tangent here for a while. Maybe we'll do that on a second conversation. I want to bring you into the heart of the matter, though, your work right now. Give me some backstory. You're a relatively young guy, but your work is pretty deep. I mean, I've gone through, and I mean, you're looking at all the different. You're turning over all the right stones, that I would want to turn over, and things that I was not aware of. How did you get your start? What's the backstory of why you are even in this space right now?
It's a weird story. So I started out. My dad is an investment manager. My dad's a financial advisor and investment manager. So I grew up kind of steeped in that world. Started out college with an eye to following in his footsteps. A couple years into my college experience, I dropped out for a couple of years to go be a missionary in Southeast Asia. Came back from having lived in the Philippines for a few years with sort of this, we'll call it a bleeding heart, so to speak, and wanted to do good in the world, and said, you know what, I'm going to be a psychologist. I'm going to go do good in the world. Got about 2 or 3 years into a PhD in psychology and realized that I didn't want to talk to sad people all the time, but I did really enjoy thinking deeply about why people did the things they do, and found the market to be just a really natural backdrop against which to measure human behavior. I mean, the amount of data that we receive, the sort of real-time updates you get to human sentiment are fascinating, and it's frankly something that clinical psychologists aren't afforded in the same way. And so, yeah, I have just been real lucky to kind of have two great loves of investment management and human behavior, and be able to combine those in a satisfying way. So that's sort of how I got my start.
Well, going through your book, I love the idea, and I would love for you to tell this story, but I love the idea that you're willing to take a chance to go out on a ledge, to walk the plank with something extremely different, to bring people into a new way of thinking, a rules way of thinking. I want you to explain the guinea worm story.
I tell you what, man, everybody loves or hates that guinea worm story. So I grew up in Alabama. I live in Atlanta now. I love the South. The American South is such a weird and wonderful place. And so I tried to start out the book with an Atlanta story. And one of the things that I think Atlanta is under-recognized for is being the center of epidemiological research really in the world. And so we've got the Carter Center here. Of course, we have the CDC. And one project that the Carter Center and the CDC did together was, for the first time in human history, they eradicated a disease for which there is no cure, and that disease was guinea worms. And guinea worms were infecting millions of people each year in Africa, were decimating economies and the prospects of the people who lived in these countries, and there was no cure for it. I mean, there was no pill, there was no shot, nothing you could do. And so they said, we're going to have to take a different tack. And so the way that it works is, when you get guinea worms, they exit through your feet. This is kind of more disgusting than you usually get on the podcast, but they exit through your feet, and the only way that you can get relief is to go put your feet in water. Well, in these villages, there are communal water sources, and so someone runs selfishly down to the water source to get this relief and ends up infecting the rest of the village. And so what the Carter Center and the CDC did, they came up with behavioral interventions, which were basically teaching the villagers to identify and then to quarantine, to just sort of create a social construct whereby, look, if you identify your neighbor or your sister, your brother has guinea worms, you do not let them go near that water source. You keep them where they are, and you make them gut it out. And by doing this, they literally eradicated millions of cases of guinea worms a year, and have saved the economies of a number of sub-Saharan African countries. And so the reason I relate this story is because following a few simple rules, they brought about this, frankly, miraculous effect of something that's never going to go away until we come up with a cure. And I think investors are likewise saddled with this disease of irrational investor behavior. I mean, I think we're about as ill-equipped to invest as we are to do anything as a human family. But by following a few simple rules, I think we can have similarly powerful effects.
I was just thinking of an economist named David Ricardo. You've probably, I think he's actually quoted in your book, a very simple set of rules. Let your profits run and cut your losses short. Look, he set that foundation down hundreds of years ago. I think it's a fair statement to say that perhaps Nobel Prizes have been awarded out to other people for that work that he figured out years ago. But that's a simple rule. But, that simple rule, cut your losses short, let your profits run. As a trend following homer, I have to say that's trend following foundation number one. But that simple rule is extremely difficult to get across because everybody wants to buy more when the price starts to drop.
Yeah. So, that simple rule is exactly the opposite of what we're prone to do, because we have this tendency to want to get back to zero and lock in our gains, right? And so what we tend to do is sell our winners short and let our losers run. And so that's exactly the opposite of what we tend to do. So the thing about investing, and you see this throughout the book and throughout the research, is none of it's rocket science. And sometimes I get a little frustrated. The ideas with which I invest and the ideas I write about are so simple, but they're not easy. And so you need rules, you need an advisor, you need whatever to help constrain your bad behavior. Because as simple as that rule is, it runs 180 degrees against human behavior.
When you say, though, easy is relative to what one knows at a certain point in time. So for certain populations, it won't be easy. For perhaps some very experienced populations, I had a conversation with a guy the other night. He was featured in the Market Wizards book, Larry Height, and Larry was just basically telling me it's so easy. And I don't want to make it sound bad, but he was kind of like, it's so easy. It's like robbing a gas station or something, he said. It's like, just because he's been doing it for 40 years and he knows deep in his bones that, if he's got a loss, he's taking the loss.
Yeah. Well, the reason that I think these things stick around, though, is because they sort of do go against the grain of human behavior. And so, I think these things are going to persist. Whereas sort of these silly little anomalies like calendar effects and days of the week and things like that are easy to arbitrage away. It's very hard to get the crowd to move against its base impulses. And because that's the case, I think that any sort of investment discipline rooted in psychology has a better chance of sticking around.
So let's get to the really, really big picture of your work, and then we'll start to backfill in too. You point out the paradox. The paradox is, we must invest in risky assets because if we don't, we're just going to get the 0.5% or the 0% of negative interest rates or zero interest rates. But on the flip side, your premise is, okay, we have to take those risky choices, but to take those risky choices, you need essentially, and I'm paraphrasing here, mentorship. Why don't you explain this paradox from your perspective?
Yeah. So the paradox, God couldn't design a worse investor than the average human being. So many of the rules, we just talked about one. So many of the rules of investing are run contrary to what is simple and easy for us to do in our everyday lives. We don't do well with uncertainty. We don't do well with volatility. We live in the present and not in the future. All these things are hard for us to do. So one of the things that I talk about in the first part of the book is the need for a lot of people to get guidance. You talked earlier about the gentleman who said it was so easy because he's been doing it for so long. But one thing I cite in the book is that we lose 13% of our IQ under duress. And so even if someone's a regular listener of your podcast, has read all your books, has read my book, whatever, has done all these things to educate themselves, that knowledge tends to be out the door when we need it most. And so, I talk in the book about the research around people who work with professionals versus those who don't, and how those who work with professionals tend to do much better. And it's frankly not because most investment advisors or even most stock pickers know what they're doing. It's because they keep you from making a handful of really egregious mistakes over an investment lifetime.
If you can't have the rules that you're going to stick to, buy, sell, how much you're going to buy or sell, here's the portfolio. If you can't have that, why play?
Well, I think a lot of people engage in it as an ego exercise. They want to prove how smart they are. They want to be the master of that destiny. And that's, that's an impulse that I understand. I mean, elsewhere in life, if you do more, you get more. But in investment management, so often when you try and overcomplicate it, you get less. It's a natural impulse again, but not one that leads us to a very good place.
You mentioned ego. I'm quoting from your work, which you're quoting from another work, which is, you're not special. You're not a beautiful or unique snowflake. You are the same decaying organic matter as everything else. And that is from the Fight Club.
Fight Club,
book.
Yeah.
So what made you think that Fight Club was appropriate to go in this work? Might scare off some of the rather conservative, older, stodgy investors. Doesn't scare me off. I know why you put it in there, but what was your thinking?
So many times we know the rules, but think they apply to other people. I spoke with my best friend, lost his dad this week, and he said, "Look, I know bad stuff happens. I just never thought it would happen to me." And I think that, his experience is so reflective of our human experience. And when you look at studies, we tend to delegate the dangerous and own the advantageous. When you ask people, how likely are you to get divorced or get in a car accident or, get cancer or whatever, people rate that likelihood as extremely low. When you ask people how likely are you to win the lottery or pick great stocks or, yada, yada, people rate that as extremely high. I think the hallmark of a good investor is realizing that the rules do apply to you. The rules do apply to you. This isn't just something that applies to other people. And I think a failure to own that the rules apply to us explain a lot of bad behavior, why people don't follow investment rules, why you see stuff like home bias, why you see people locking in bad tendencies around when to buy and sell. So I think you have to own the fact that you're no better, you're no more special, you're no more gifted than the next person if you're going to be truly great. There's, again, a paradox in owning your own imperfection on the way to doing something special.
Even though the wisdom of the Stoics and perhaps the Eastern Zen traditions go back millennia, for the average American, I don't think Stoicism and Zen perspectives is really something that we grow up with. It's maybe when you get older and you kind of like start to get exposed to somebody that walks you down that path. But both of those traditions really dive right into where you're going.
Well, they do, and you're right. I think these are understudied in America, and I think it's very consistent, this idea of being sort of a roll up your sleeve, be a hardworking, gunslinging, stock picker.
Don't pick on the gunslingers. Don't pick on the gunslingers. I got a lot of Second Amendment guys in here, and I'm probably one of them. So
look, man, I'm from Alabama. You're not gonna find me picking on gunslingers. But you know what I'm saying. I mean, I think there's something that's very red meat and apple pie in baseball about doing fundamental research, picking 10 stocks, and living and dying with that. Unfortunately, the research doesn't necessarily back that up. But I agree, there is something very American about that way of doing things, even if it's problematic in some way.
Because I think also too, maybe we get a little bit caught up in the big story. I mean, really, it's kind of crazy that as long as America's been around, for as many successful investors as there have been, really most people only think of Warren Buffett, and that's it. I mean, and there's no other Warren Buffett exactly that I know about. He's had, he set this up a long time ago. There's first mover advantage. He has a unique structure. I take nothing away from him, but the idea that Buffett is, a half dozen stocks that he picked a long time ago and held on for dear life and now has made a fortune, that's not exactly what happened. And it is a touch more complicated than that.
Well, I love Buffett, but even a lot, there's a strong element of do as I say and not as I do with him. I mean, he's bad-mouthing derivatives while owning them, and I get it. Look, he's speaking to, folks in Nebraska or folks at his meetings, and they shouldn't be operating at the same level of sophistication that he is. But yeah, I mean, there's sort of the quotable Warren Buffett, and then there's Warren Buffett in practice.
Which can cause confusion, to say the least. I mean, because it is like the number one example And if you really dig into his work very respectfully, he understands the use of leverage. He knows what the Kelly criteria is. I mean, he's a very bright guy doing very bright things with his partners.
Yeah, absolutely.
Yeah. Let's jump into something very simple sounding, but I think you can tear it apart. We control what matters most. And I would argue that what matters most is controlling loss. And if we go into the markets, we all have the ability to control how much we are willing to lose, don't we?
Yeah, we do have some control over that. Now, that first chapter, you control what matters most, is trying to reinsert some ownership and some pride and ownership into the investment conversation. Because I think when you speak to most people, and indeed the research backs this up, when you speak to most people, you say, hey, what's the best predictor of your ability to meet your financial goals? And they're going to say, well, it's going to be the economy, and it's going to be Janet Yellen, all these externalities. Well, all the research shows that most investors tend to leave about 50% of their gains on the table because of poor behavioral decisions they make. And this is over long periods of time. And most investors just barely keep up with inflation. And so, again, this is why I'm advocating, and you're advocating, a rules-based approach, is because far from taking advantage of all these anomalies that we've talked about, most people are doing well worse than average, which is why you see people like Warren Buffett, Dick Thaler, and others who, while they don't believe in the efficient market hypothesis per se, sort of espouse an EMH brand of investing to retail investors. So this is me trying to say, look, you are the best predictor of your success or failure. So own that from the outset and don't blame it on the market.
I mean, I think your work is really kind of a can opener to all of these issues. I mean, you're not trying to say there's one magical answer, but look, you got me sitting here with a bunch of notes in front of me who went through everything and was like, okay, I want to talk about that. I want to talk about that. But let's also speak to something that I'm seeing a lot right now. So I can still remember that feeling in March of 2009. In March of 2009, there was no investing strategy that said in March of 2009, it's time to go long. There was none. There was nothing that said that it was time to go long, because in March of 2009, it sure as heck felt like the market could go down another 50%. However, from March of 2009 to October of 2016, it's been one heck of a run. And I've just started to notice in a lot of the major publications, financial publications, all these people are getting all this notoriety for running passive index funds. It's all the rage. There was a big mutual fund the other day that we got a lot of press, how smart they are to be running the passive fund. And I think it was the Nevada state employees guy. He's one guy running, I don't know how many billions, and he's got no employees, and he eats his lunch at his desk, and he's running a passive index fund. What I don't get about that is that if we have another 50% drop, which I think is more than an if in the future, because we've had a couple in the last 15 years, just in the overall equity indices. I mean, are people really going to be comfortable with the idea of like, well, we took the passive index fund and it dropped 50% and we're happy with it? And then on top of that, I know it's kind of a long question, but on top of that, what happens if we do get the 50% drop for the third time in 15 or 16 years, and then we go Japan? And it never goes up again and stays down 50% for 30 years. I mean, it's kind of a crazy strategy, in my humble opinion. Am I completely off my rocker?
So, yeah, there's a lot. Let me try and dissect it. One of the chapters in the book is called Excess is Never Permanent. And some of my research, there's two sort of major streams of research I have. One is around developing quantitative measures of investor sentiment, and the other is around developing a composite quantitative measure of broad equity market valuation. So right now in the U.S., my metric has us at about just south of the 90th percentile for the S&P 500 relative to history.
What does that mean exactly for you?
That means it's as expensive as it's ever been in history, more or less, with the exception of maybe 2000. So we're in sort of 2000 and 1929 territory with respect to valuations.
Half my audience just left the conversation. They are now in their bunker with their shotgun.
Yeah, I told you I wouldn't speak ill of guns. So, I mean, that is what it is. What we can know is how expensive things are, and we don't know exactly when that's going to turn. I mean, I think trend followers can watch for that turn and take advantage, catch a 10% dip instead of a 50% dip. But there's no denying that these things occur, and that they occur with greater or less severity relative to how tightly stretched valuations are. I mean, I conceptualize it a bit like a bow and arrow, right? I mean, if you stretch that string very tautly, when you let it go, you get the arrow gets propelled at a higher rate of speed. Similarly, I think when you stretch valuations to the point that they're stretched now, when you let go of that arrow, the momentum starts to flag. I think you get, a very, very negative reaction. In that respect, I think people who are passive are going to have a very bad time. Over history, you could have also done a lot worse than being passive over the last 10 years, because frankly, so few quote unquote active investment managers, I think, are doing it right. One of the things that I talk about in my book is how 3/4 of what are marketed as active funds are really closet indexers. And so I think that, unfortunately, a lot of the reasons why active management has gotten a bad reputation are very well earned. You've got expensive, low conviction products that aren't following rules, that are making investors susceptible to all of the behavioral biases of the managers. All the research shows that active investment managers, by and large, tend to do all the wrong things. They tend to sell low and buy high and do everything you shouldn't do. On the one hand, I think active management has, by and large, earned its bad reputation, but I do think in the medium term that passive folks are in for a rough ride. And I think all this stuff's cyclical. I mean, we've had an unbelievable run. I mean, if you just bought the S&P for the last 7 years, you've been beating everybody. And so you get articles like the ones you're seeing, and I think the tenor of those articles will change sometime in the near future.
Whether it's active or passive, really, it's so much of Wall Street just comes down to fees, and it's whatever smart guy or whatever smart group can slosh the money around from this pile to that pile and try and get a fee. So much of it's that. Why don't you also speak to the passive guys, though? Because the passive guys are indoctrinated in the school that we brought up in the beginning of this conversation. The passive guys are all indoctrinated in EMT. These aren't behavioral guys, by and large.
What I've tried to do with my work is show a little bit of a middle ground. If on one extreme we have buy and hold passivity, on another extreme we have, the 10 stock, deep research, high conviction, active management. I try and be somewhere in the middle. I mean, I try and show that, look, there are some things that are really laudable about the passive management movement. Managing fees, tax alpha. Little things like this make a tremendous difference over time. Diversification, things like that. But I do think that there's a middle ground, and I do think that you need some sort of protection. And decreasingly, it's getting harder and harder to get that protection through just sort of a simple diversified strategy. I mean, the only thing that went up in 2008, 2009 was correlation, right? Like, no matter what you were holding, you were in trouble. And so I do think that there needs to be a greater element of risk management. And another thing that I talk about in the book is, with increased information in our age, we're not seeing markets get more efficient. We're seeing them get less efficient. I mean, you're seeing more and more dramatic and more frequent bubbles, panics, and crashes. And I think that the new normal is we're going to see dramatic rises and falls, partially as a result of how closely we're monitoring all of this stuff.
You mentioned or you kind of hinted at the heuristic, the idea of too much information. So we have too much information, and I look at my world, the trend following world, they got the heuristic of price action. So instead of trying to go through all of the fundamentals, which I think is impossible, one just says, you know what, I'm going to trade this price action. In many ways, I think this can be hard for people to accept about time series or even cross-sectional momentum, is it's not really investing in any way that we really know about. It's literally like a kind of a video game of just trading price movement. It has nothing to do with value. And I think that alone can cause people to be like, man, I just can't wrap my arms around this.
I set out sort of 4 pillars of what I think are a sound active management approach. And one of the pillars is what I call clarity. You know, it's a very American idea that more is better. A lot of people want to look at every possible variable they can, right? And so I talk about why that really doesn't make sense. And I show some of the research that shows that at some point, considering more variables actually gets you a worse return. And I talk about how the Fed releases 45,000 pieces of economic data each month. And you just can't make sense of it all.
You got to make buys and sells. I just don't know how any of that translates to buys and sells.
Right. Well, and so I'm not a strict momentum investor. I do incorporate it into my strategies. But one of the things that I think is nice about your approach is it relies on one signal more or less, and I think there's some cleanness and some clarity to be had with that.
Let me let you clarify all 4 of those really quick. You kind of call them the 4 C's: consistency, clarity, courageousness, and conviction. Why don't you go through those 4 really quick so people have a good broad overview?
So the first is consistency, which is the rules-based approach. We think that's been well covered at this point. The second is clarity, which is I look at just a handful of metrics, because again, at some point, the information begins to cannibalize itself, or you do what Nate Silver calls, something. He said something to the effect of putting all this information in a blender, blending it up, and calling it hot cuisine. It's not, right? We need a handful or less of important, impactful things that you look at. The third is courageousness, which is basically automating this process of buying low and selling high, or like you talked about, letting your winners run and selling short your losers. And then the final one is conviction, which is sort of, I refer to it as sort of Goldilocks conviction, finding that nice sweet spot between owning too few stocks, because I'm shocked as I go out and speak how many people will come up to me and say, look, I work for Lockheed Martin and I'm all in on Lockheed Martin stock, or I'm all in on Apple, or whatever it is. I see that with surprising regularity, and it pains me. So finding that sweet spot between holding 1 or 2 stocks and being over concentrated, and then owning the index, which is no conviction at all. So I talk about trying to find that sweet spot and set aside some of the research around that.
Let me get schizophrenic on you and whip you around to a completely different area. So, for a man that has studied quite a bit of psychology, a little bit of psychiatry, I'm sure as well, tell the audience out there what they can learn from his teachings, his writings, the insights. How can Sigmund Freud help us all as investors?
Oh my goodness. How can Sigmund Freud help us as investors? Oh my goodness. So that is schizophrenic. So Sigmund Freud gets a bad reputation for being all about sex, right? And I mean, indeed, that was what underlied a lot of his sort of the motivating animus for his theories. But Sigmund Freud's work is at the base of pretty much any psychology you'd like to study. And so the way that I think his work impacts us, I think, is in sort of a behind-the-scenes way. I mean, he's the one that introduced notions like an unconscious mind, like things happening, biases and heuristics and decisions happening sort of beneath our awareness. So he set these things up at a time when they would have been outlandish to people. And we accept this as very, very much factual now. I think that the way that Freud's work impacts us is that he blazed a trail by introducing ideas that were heretical at the time, that are very much now just a part of our daily life, that are so deeply interwoven into the theories of people like Thaler and other prominent behavioral economists that you don't even recognize them.
Yeah, I think it's a great point, because I've had so many behavioral guys on my show, and I think maybe I have a quote or two in one of my books from Freud, but I really it makes me, when I was reading something in your work, I was like, I got to go do some more homework. I mean, obviously it's not my background, but it makes me want to go do more homework because as you point out, it's the foundation.
Oh yeah, he doesn't get enough credit, if that's possible, for doing the hard work of making these ideas just enter the public consciousness.
I'm going to jump around on you again. Look, there's a lot of jumping I can do here. I could jump around for about 5 hours. Trouble is opportunity. I like that a lot. I've seen it said in different ways, but those 3 words together are really nice. However, for most people, trouble is opportunity. Hold on, I don't want trouble. I don't want any trouble. Well, trouble is opportunity, isn't it?
Yeah, trouble is opportunity, and I think again, this is one of those things that everyone knows and no one does. And I talk in this section. I try and erode people's notions of free will, I guess, in this section. And I talk about some of the research around willpower. So everyone thinks that, hey, when it hits the fan, you mentioned March of 2009. When I get in March of 2009, I'm going to be all in. That's when I'm going to get aggressive. I think we need a couple of things to take advantage of the March of 2009s of the world. The first is we need a metric to show us again, sentiments and valuations. This is why I measure these things. I mean, we need a way of quantifying, where are we relative to history? What kind of opportunity do we have? Because my sentiment measure was at a 5 out of 100, 0 being sort of the hypothetical lowest possible. I was at a 5 out of 100 in March of 2009. Lowest sentiment I've ever seen. I could have told you then, using that measure, hey, this is likely a good time to get going. Whereas most people, if you're just relying on your emotions, it feels too dangerous. So I think one thing that we need to take advantage of trouble being opportunity is some sort of objective measure of what sort of opportunity we're looking at. And then the second thing I think we need is an understanding of how poor our free will is, or how our free will acts. I talk in the book about marital infidelity. And people think that marital infidelity probably is highly correlated with something like religiosity or sort of self-professed morals. But the best predictor of marital infidelity is opportunity. Basically, how rich are you and how good looking are you? The best predictor of whether or not you're going to sleep with someone who's not your spouse is if anyone wants to sleep with you, which is basically, a nice way of saying we're not as strong as we think, right? We're not as strong as we think. So we need to set up rules that keep us from making poor decisions. So this is, again, another instance where in order for us to take advantage of trouble being opportunity, we have to have a rule in place, a system in place, an automation in place that makes us do the scary thing that we don't want to do.
You mentioned March of 2009 again, or following up on what I said. The other side of the coin, from instead of the value perspective, could have been once it hit its lows, somewhere off the low, moving up, trending up, a breakout, a moving average, something from a trend following perspective, a time series perspective would have got you in. So there's different ways to skin the cat. I don't think anybody picked the exact bottom, though, or very few did.
Oh, no. Well, and I think being a behavioral investor means you give up the notion that you're ever going to pick the tops and bottoms, right? I mean, you're never going to get perfect at calling tops or troughs in the market. But what you can do, though, is use a momentum strategy, use a value strategy, or I favor some combination of the two. Because what I found is that mean reversion tends to be stronger or weaker depending, again, on how stretched we are from fundamental value. So if you pair a value strategy with the momentum strategy in a March of 2009, and you say, look, we're at a very depressed valuation, and look, now the sentiment, the momentum starting to turn to, here's two good signals that tell me it may be time. So I think that pairing those two things is awfully powerful.
So there's the controversy. So I was also looking today, I had him on my podcast, and Gary Antonaki, he's got the dual momentum investing thought process where he's saying, I'd like to take both forms of momentum. And you're saying, hey, let's take some momentum and some value and combine it together. I guess what you're really saying too is that, if you take value and you take a momentum like time series, it does, on the efficient frontier, usually give you more return and less risk.
Yeah, it does. And, what I found, if you look at a simple, part of what I've done, part of my research is I looked at simple momentum strategies like, the one Med Faber wrote about, just a sort of a simple 200-day moving average strategy. So if you look at how just a simple 200-day moving average strategy does over long periods of time, you do very well. I mean, you beat the benchmark, you manage volatility, you compound off of lower lows, and your final sum is a great bit higher than it would have been if you had just indexed. But you still get a lot of false positives. And what I've found is you can get rid of a lot of those false positives if you pair value and momentum. Because when the valuation is not very great, the market's not perfectly efficient, but it's kind of efficient. And so people tend to say, look, they get back in relatively quickly. The drawdown tends not to be too steep. It hovers right there around fair value. But when we get greatly disconnected and you have flagging momentum, that's when I get scared. And so right now, I think the greatly overvalued condition is met, and I'm waiting for that momentum to flag before I really run to the bunker.
The black swan will swim in one day. We don't know when or how, but it will come. Hey, let me shift gears in a little bit. Similar headspace, volatility and risk. And I've talked about this a lot in my world too. I'll let you run with it. So many people just perceive, and even very smart academics, that volatility is risk. Not necessarily so. And standard deviation is just a measure of risk, can really lead people to perhaps incorrect conclusions.
Yeah, absolutely. I mean, people need to understand why standard deviation, why volatility got introduced as a proxy for risk in order to then sort of combat that idea. And the reason that it got introduced as a proxy for risk is because it helped us build elegant, beautiful mathematical models. And people could get Nobel Prizes and build their careers at the University of Chicago on ideas like this. What it's not is a very useful thing in practice. And so, chapter 10 in my book is called Risk is Not a Squiggly Line, and it helps people understand, more fundamental conceptions of risk and also ways to manage it, because it's a very poor predictor. And again, you look at a lot of these strategies. You can there's risk and volatility are related, but it's far from a perfect relationship. And your ability to exploit that can make you a lot of money.
I had a presentation a few years ago and gave a kind of a time series momentum trend following presentation. And a very smart lady in the room, I could tell she was very smart. I was in Singapore. Everybody in Singapore is smart. And right. she raised her hand, and immediately it was the first 5 or 6 words. I was like, okay, I know where this is going. What's the Sharpe ratio on it? It's like you just want to do the Vulcan mind meld and say, listen, you've probably had more education than I have. You probably have a higher IQ than I do, but you don't know what you're talking about.
Well, I got into this. I was pitching to an unnamed large institutional investment firm recently, and they wanted to know about tracking error, and we're using tracking error as a risk proxy
to a benchmark. To a benchmark, you mean?
Yeah. So how much did it deviate from the S&P? And I said, who cares? This is, and they didn't love that answer.
but that's a great issue, though. I've got one of the things I was going to ask you about before we run out of time. The benchmark issue is huge. I mean, leading one's life as just they must meet or match the benchmark, and if the benchmark's down 50%, then okay, you match the benchmark, and that's how so much of Wall Street runs their lives. It makes so much money is by matching the benchmark, even if it's down 50%, or for that matter, at the end of the dot-com bubble when the NASDAQ was down 77%, those fund managers were matching and beating or whatever the benchmark.
I mean, it does so much bad in our industry. The first thing that it leads us to do is it's how we get these low conviction, crummy, expensive, low conviction, not differentiated, quote unquote, active strategies. The reason that's the case is because Wall Street's benchmarking to the S&P or whatever it is, and they have that career risk. They don't want to differ dramatically from the benchmark. So that's one negative effect. For average, just everyday retail investors, it actually leads us to make poor decisions. I talk in the book about people who benchmark to the S&P versus those who benchmark to just the returns they need to live the life that they want to live, and show that the people who have that personal benchmark are much more likely to stay the course, to follow their rules, and end with higher closing account balances. There's just nothing good about indexing to something impersonal. And then again, when it all hits the fan, you can be happy about a 45% drawdown when everyone else got a 50% drawdown. Regardless of how it's crushed your ability to live the financial life you want to live. It just doesn't make any sense.
And sadly, I think one of the reasons that the benchmark concept sells so well is, again, right into your psychological sweet spot. People have a fear of not being exactly like their neighbor, Bob Jones. So if you're not exactly like Bob Jones, then that fear alone drives people. Whereas Bob Jones' time horizon, his strategy, whatever, could be different, not related to you, not important to you. But people get so caught up with the idea of what's the neighbor doing? What's the neighbor doing? And a good portion of all the error and the biases and whatnot that you describe in your work is all related to this monkey see, monkey do stuff, isn't it?
Yeah, absolutely. And there's a great Harvard study. I'm going to get the actual dollar figures wrong, but I mean, they basically asked students, would you rather be someone making $40,000 a year in a community where the average salary was $25,000 a year, in a neighborhood where the average salary is $25,000 a year, or would you rather make $200,000 a year in a neighborhood where the average salary is $400,000 a year? And people will take less money and better relative position. And it's crazy. I mean, it's crazy. It's all about the monkey see, monkey do thing, like you said, and our tendency to benchmark to other people. And it's interesting. I talk in the book about Isaac Newton. Isaac Newton made tons of money. He was Sir Isaac Newton, famous in his day, well respected, very wealthy, piles into the South Sea Company, makes a ton of money, gets out early, sees that his neighbors have stayed in and that they're getting richer than he is. He piles all his money back in, loses it all in a bubble, and dies penniless because he couldn't keep his eyes on what he needed, right? He had to benchmark relative to someone else, instead of having that personal benchmark. And
so what does IQ have to do with investing success?
Yeah, there you go.
Yeah, that's a good place to end it for this conversation. Daniel, the book, The Laws of Wealth, Psychology and the Secret to Investing Success, came out in June. Looks like it's doing pretty good. Everyone can find it everywhere, right?
Yeah. Just jump on Amazon and pick it up.
Where else can we send people? You have a main website we can send them to?
Yeah, Nocturne Capital. So Nocturne with an E, like Chopin, right? And then at Daniel Crosby on Twitter.
Okay, appreciate it. Good conversation. We covered a lot of area. For never talking before, I appreciate that you were willing to run in different directions and banter back and forth. I'm sure people will enjoy it.
Absolutely. Thanks so much for having me.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.